I'm Matt Bichard here in Dallas for NAREIT's REIT World 2017. Joining me today is Don Miller, the CEO of Piedmont Office Realty Trust. Don, thanks so much for joining us.
Oh, thank you, Matt.
In your comments on Piedmont's third quarter earnings report, you mentioned that you're optimistic about leasing. What are some of the trends that are driving that?
The market has been fairly steady for the last couple of years from a leasing standpoint, but we've seen a lot of ebbs and flows. And the first 3 quarters of this year, we didn't report the level of leasing activity that we had hoped we were going to report, but it seems like it just had backed up over the course of the year. So as a result, we've been very open about the fact that we expect our fourth quarter to be our most robust leasing quarter of the year by a material amount. And I'm not sure that that's necessarily indicative of a longer term trend towards changing and increasing absorption as much as it is just a function of what's happening within our portfolio at this point in time.
Now, shifting to the balance sheet, how comfortable are you with where things stand right now?
Well, we're probably in the best position we've ever been in from a balance sheet perspective. We announced earlier this week that we have a portfolio of 14 assets for sale that has been gone hard now. Anticipated to close in early January, and if that happens, with the pay down of debt associated with that, we'll be down to the lowest levels of leverage we've ever experienced. The debt to EBITDA will be in the mid to upper 4s. We'll have debt to gross assets of 27-ish%, and so in combination with that, and the fact that we have almost no mortgage debt, no encumbered debt, and very little floating rate debt, we feel like we're in the best position we've ever been.
And what geographic markets are looking particularly strong for the office sector as we head into 2018?
Well, as you know, we occupy space in eight markets, really. I would say that each market has its own benefits and detriments. It's part of the benefits of being diversified. But I would say that the Sun Belt markets are probably the strongest markets we're seeing right now. Some of the more stable markets like Chicago and Minneapolis are performing quite well. Say the weakest markets probably are Houston, no big surprise there, and Washington, D.C. continues to be a little bit of a drag on us.
Great. And I imagine part of that is the supply-demand balance for office space in all those markets. If you could speak to sort of the overall view of supply-demand for office.
You know, I would say supply-demand feels like it's in pretty good equilibrium in the office space universe, and there's not a lot of things that are really giving us pause for concern in most of our markets about new supply. Probably the main reason for that, the main benefit of it, is that we own a lot of Class A office in our markets, and that Class A office is still transacting at lease rates that are well below what it would cost to build new product and get lease rates associated with that new cost. So that broad gap is giving us comfort that there isn't going to be a lot of new supply, and if there was new supply, it'd probably be because lease rates grew dramatically, and that would be obviously beneficial to us. So we feel really good about the markets being generally in equilibrium at this point in time.
Great. Don, thank you so much for joining us.
Well, thank you, Matt. Appreciate it.
For more from REIT World 2017, be sure to visit NAREIT's website, REIT.com.